Welcome back. For macros and markets, we have with us Maneesh Dangi from Mosaic Asset Management joining us on the show now. Maneesh, morning. This is Reema here. Wanted to first get your assessment on the US economy. The latest jobs report seems to suggest an increase in the unemployment rate, a decline in job creation. So it does appear the US economy is finally showing signs of, cooling off after being red hot for so long, much longer than what, people were anticipating. So your assessment of the US economy right now, and what does this latest jobs data suggest in terms of what the Fed might do?
Hey, Rima. So you're right. Of course, the employment sort of weakness come in somewhat late, in a sense. You starting to see some slack there. The old numbers are getting revised downward. In general, most of the nowcast in terms of growth is sort of hinting at a possibility of slowdown. I still think that markets are too perky and sort of too confident of good second half. So it's very, very likely that US lows, what Citi put out yesterday, that there could be over next 8 meetings, 25 basis point each rate cuts. And I've been of this view for sort of fairly long that, you will have US rates in threes, actually, a three handle, three quarter, three half in 2025. I think, markets are sort of underappreciating the undercurrent of slowdown in the US. So, I agree that you would have significant slowdown in US over the next 6 to 12 months, and you'll have significantly lower interest rates in US than what markets are baking in right now.
Maneesh, good morning. Thank you for joining in. It's more of a catch-22, right, for the Fed, because this data is coming right on the back of Jerome Powell saying last week that they would still want some more data because they're still not confident enough to cut rates. Is it so that the Fed is starting to fall behind the curve, because there are central banks that have started to cut interest rates already? And assume the fact that there is a macro data that comes in next month, which is contrary to what the street is anticipating. Does that put all of these estimates out of the window again?
So it's been sort of hot and cold. You saw 3 months of inflation, actually, data surprising on the higher side. And we had this conversation many times that, would that suggest that near 70s like perk up in inflation on cards? And I argued against it. I think in US, more than what Fed or Powell spoke last time, one is, of course, politics there. If both House and the presidential seat were to go to Republicans, it's likely, and markets are worried of the fact that, you could very well have sort of more perky fiscal, already sort of bloaty fiscal or public debt that US has, it could get worse. You also have, other hints coming in from the fact that copper is perky, the crude has actually risen again. All of this is actually unnerving bond markets, So even while you see clearer signs of disinflation and, more importantly, growth slowing, copper, crude, politics, all are actually confusing bond markets, and which is why, bonds haven't really rallied. So it's this whole macro cycle, Chief, over last couple of years has actually played very, very uniquely and distinct from what we all are sort of are used to seeing. But big picture, slower growth, lower inflation, and Fed cutting rates, that seems to be sort of the game in town, at least for next 1.5 years.
Since you spoke about bond markets, last week was that watershed event for the Indian bond markets. We've been discussing this. India finally got added in the JPM bond index. What have been the inflows so far? We've discussed the potential inflows over the next 10 months, but so far, any anecdotal evidence of what we've seen already? And now for the FPIs, there's really an attractive option, Indian equities versus the Indian debt market. What has been the feedback from FIIs, the foreign investors, on the attractiveness of Indian equity versus Indian debt now?
So sort of we've discussed this many times. Indian bonds actually are better currency play. Yeah. There are sort of great amount of tailwinds. It's very likely over a longer period rates would head significantly lower. Inflation differential between India and Western world has actually collapsed. As we speak, core inflation is in India is could very well be lower than US's. So in some sense, what played out in China over the last 10, 12 years could play out, and I think smart money would bet on this trade. I've argued on your show that how in the next cyclical downturn that you will have over next 2-3 years, Indian bonds would get to a 5 handle, not maybe exactly 5.5%. So there is a significant, space for bonds to rally in India. How much money? A lot of money, of course, has come in. First time on a 12-month run rate basis, you have sort of significantly more money coming in bonds. Equities have been investors have deserted, and you haven't seen much money coming in there. So I still think that the game has just begun. I think, from a broad asset allocation point of view, for the given currency and where bonds are valued in India, you still have a tailwind for next many years. I wouldn't be surprised if this number of total money flow in India would run into, $50-100 billion over next 5-6 years.
Interesting. Now, Maneesh, let us assume that the Fed does bite the bullet eventually and starts cutting rates in September. Now, the probability of that, if I'm correct, is now around 72% for a rate cut in September. What does that do to sentiment across the market? Because the US market itself has been a significant outperformer already this year, particularly the S&P and the NASDAQ. Does that also now cause a shift in flows back to the US once the Fed starts cutting rates? Or do you see that the EMs would continue to get flows, considering the fact that barring India, most of the other EMs have not done too well?
So in US, basically what has done well, of course, since October is mostly IT and communication. And that part of the market, of course, had a cyclical downturn in 2022 and 23. So it's sort of a recovery. As we said, this macro setup has been messy. Different sectors have been slowing and then re-accelerating. So the tech and communication piece, if you were to see in US, is actually seeing a recovery of sort. Very, very slowish one. Still no employment growth there. Yet, productivity has risen, and overall earnings have been sort of pretty decent. So because these are high duration assets, tech and communication, you also tend to have lower rates actually helping them. So the internals of US markets are very different than that of US, that of India. India, small and mid caps have done remarkably well, are more expensive, whereas in US, they're actually much cheaper than, even from a historical standpoint, much cheaper than large caps there. There, the industrials, discretionaries haven't done well. In India, just the reverse, real estate, discretionary, and all sorts of hyper-local assets and economic assets have actually, or shares have done well. So from a market standpoint, I guess the current momentum suggests that it's baking in some bit of a recovery in IT and communication in US, along with, of course, lower rates, and which basically would continue to play out. The hardcore economic sectors there, the materials, metals, industrials, and all of them, are not doing well, and I don't think they will do any well over the next 6-12 months.
Maneesh, thank you very much for joining in. Need to get into that break, but on the other side, we'll discuss the Indian technology space with Rakesh Kumar from BNP Paribas.